Hello and welcome to Investing Confidential. We had a nice rally pre-market. Retail sales numbers came out. Looks like they were better, but I'm going to show you why they were not better and why the market reacted perfectly by going back down again. But I want to start here with what a real bear market is, okay? I guarantee that most of you out there who are listening to this video have never experienced a bear market. And in fact, someone like me, a lot of decades of experience in the markets, I really haven't seen that many bear markets or felt real bear markets. And the last time we really had a real bear market was many moons ago in the 70s and 80s. So let's get right into it. Let's look at what a real bear market could be. So what we see here is what we called back in the day the Nifty 50, and these were the 50 stocks that led an amazing run during the 70s. It was really the entire market was just, if you didn't own one of these 50 stocks, you made no money. Anyway, they crashed, as everything eventually does crash. But then we had nearly a decade of dead money, and you could see here the CPI in the 70s peaked, but the market continued to go sideways for quite some time. And the CPI peaked as the market went lower and lower. We don't know if the CPI, some people are saying the CPI's peaked already. I don't know. I think certainly we look like we have peaked, but we're in for a long run. And as you can see here, we could be in for a long period of time of dead money. So just realize, just because some numbers came out and they look better than expected, all of a sudden we're going to have this another bull market start. That's fallacy, okay? Complete fallacy. So let's now turn our attention to what happened this morning with the retail sales numbers. And I could tell you right now, as I said with other numbers in the past that I've gone through, I want to go through and tell you why these retail sales numbers don't tell the full story, and they're worthless, okay? I'm sorry to tell you, they are absolutely worthless. Look first, the talking heads here are telling you exactly, whether you watch CNBC or looked on YouTube or read the Wall Street Journal, retail sales were up 1.3% month on month in October. This is totally misleading. Okay, I'm going to show you why. Completely misleading. I mean, then in back of that, you've got the real numbers. You got Target. Okay, Target comes out and they missed. The stock was down massively this morning. It's recovered a little bit, still down 10+%. And Target cuts outlook. If you look at the recently videos I put out, I told you guys, earnings are everything. Okay, earnings are going to determine where this market goes. Target, like Walmart, is a bellwether. And in fact, I would say that Target's a little more of a bellwether than Walmart, because you get all kinds of consumers going into Target as opposed to Walmart, which is the lower end consumer. But let's talk about Target here. They cut their outlook. We discussed how earnings were not that important, but the outlook was more important. Okay, Target, which is again affordable goods for everyone, just cut their outlook. Demand is slowing. Demand is falling off a cliff. We're seeing it everywhere. Okay, and now let's go in to the real data. Okay, here we have the actual data from the Census Bureau on retail sales. Okay, monthly sales for retail and food. This is what we're measuring. Okay, so let's look at this now. And what we see here is the real numbers. Okay, what really affects everyone. They're telling you that that the retail sales were better than expected and all of this. But really what it was pricing, okay? Gasoline, look at this, gasoline stations this is what we pay at the pump. Now this is very inflationary. Prices were up, or sales were up over 17%. Now, what's the component of sales? It's the merchandise and the cost, the price of the merchandise. So it wasn't that people were buying more, it was that the pricing was higher. Okay, so your gasoline prices have gone. I don't know if you've noticed, but they have gone up quite a bit since we basically depleted our strategic oil reserve, and so we had a massive retail sales in gasoline because prices were up, not because people were buying more gasoline. Second thing here is food services. Okay, food and drinking places like restaurants, bars, and all kinds of establishments that serve food and drinks. They were up 14%. Now, again, this is not to say that more people were out there, going out to bars and restaurants and buying more food. It was just that prices were up. Okay, so when we're looking at these things and we're seeing, as you can see on the graph, prices, as you can see in the comments, prices up 14% on retail sales. On food and drinks, and gasoline is up. That tells you the whole story. The prices are up, inflation is up, and again, we talked about inflation being sticky. It's come down, some things come down, some things go up. But overall, this isn't a good number. Okay, this retail sales number was not a good number. It's very, very misleading. So let's now go to look at some actual data on this Excel spreadsheet. What you see here is very simple. Look at August versus October, right? So everyone was jumping up and down about the October number compared to September number. Retail sales up. But look at August. Now, August, no matter where you are in this, in this northern hemisphere, whether you're in Europe here, it's summertime. Okay? People go on vacation. Retail sales normally are very weak during this. People buy stuff in June, July, then they go on vacation in August. No one's really shopping. Everyone's relaxing at the beach or driving around, whatever. And so at the end of the day, if you look at these numbers, okay, August versus October, it tells you the real story. The consumer is weakening, folks. The consumer is weakening. Forget about September to October, a little blip. That's due to prices. That's due to inflation. This is real numbers, okay? Whether it's retail sales of food and other items, we have motor vehicles. We have all of this is telling us that the consumer is weakening across the board. Furniture, all of these items. So this data is telling us the real story. And now we look at the commentary, okay, the notes. How do we get these numbers? How does the Census Bureau come up with these numbers? Let's look at it. This is hysterical. Again, all of this points to the government. The way they get this data is outdated and completely nonsensical. It doesn't make sense anymore. So, like they've done for decades, they contact 5,500 retail and food service firms. And this is their numbers, out of a universe of over 3 million. Okay, we're talking about less than 1/10, about 2/10 of 1%. 2/10 of 1%. This is absurd. This is not what really is going on in the country. This is some data that may have been, when the country was much smaller, it may have worked. But now we've got, 350 million people. We've got, they say 3 million retail. We probably have 10 million retail and food service companies, and they're going out and talking to 5,500. And they're telling you that based on those 5,500, that's what the rest of the country is. That's what's going on in the country. Absolutely absurd. So take these retail numbers and flush them where they belong, right down the toilet bowl. They make no sense. The economy is weak, okay? And there are a lot of signs. Again, we've talked about used cars. I've been talking about used cars for quite some time. Here's the confirmation, finally. Used car sales plummeting, okay? They can't. There's too many used cars. They're producing too many cars. There's too many. They told you the narrative was 6 months ago that you had to pay a premium for a used car. There was never a shortage of used cars. I'm telling you, never was. Artificial. Now they're puking used cars. That obviously was a contributor to the last CPI. Okay, but again, all this is pointing to weakening consumer. Here's another indicator. This U.S. Empire State Manufacturing is very important to most economists. Business conditions, you can see here, expected orders, expected shipments, all down across the board. Any economist worth his salt looking at this will tell you one thing. We are in deep trouble. This economy is in much deeper trouble than any of these numbers are telling you. And don't let anyone fool you with any kind of GDP now and all kinds of garbage numbers. This economy is in real trouble because these numbers, the Empire State Manufacturing, PPI, these are real numbers, not this nonsense that the retail numbers. It's fallacy. Okay, Let's look at some more things. Everyone's talking about the tech layoffs, but I mentioned to you that it was happening across the board. Here's a confirmation. We've got auto companies, Ford in particular, but it's across the board, confirming that they're laying off a ton of people. Okay, that's not good. That contributes to weakening consumer sentiment for real estate, for retail, for everything. So we've got an incredibly weak economy, and no one's talking about it. All right, you got people making excuses for the weak economy, but it's extremely weak, and all of these numbers are confirming that it continues to be very weak. The next thing I want to show you is, again, U.S. chip prices. They're plummeting. Remember, going back, they talked about there's not enough semiconductors. You got to pay more for used cars. You got to pay more for appliances. You gotta wait online for things. You got to wait for years for things to be delivered. I mean, computers, etc. I mean, this is gone. They overproduced. There was a shortage for about 6 months. The companies overproduced. Now we got more chips to know what to do with. Okay, we're plummeting. So chip prices are plummeting. Again, weakening demand across the board in all countries. Weakening demand. What's this going to do? So all of this is really, at the end of the day, what is the Fed going to do? So here's the FOMC, the Federal Reserve, expectations for the next few meetings. We spoke about the last videos. It was 75, now 50 is baked in. I'm pretty sure they're going to do 50. And then, as you can see here, the estimates are lower and lower going forward, but not declining, just lower and lower, maybe 25, then halting. I don't think anyone knows what the Fed's going to do past this meeting in December. 50 basis points, it's locked in. Okay, I'm pretty sure it's locked in. There's nothing, especially with these retail sales, these fake numbers coming in from retail sales. Fed's not going to slow down. Now, what their commentary is, that's going to be really interesting. This commentary is going to be the most interesting, especially for the bulls who are looking for more reasons for a pivot and more reasons to buy the market. I'm not going to make any predictions for the Fed. The Fed is unpredictable. They're behind the curve. I think the Fed has to continue to be hawkish to keep their respectability. So I suspect that anyone looking for a pivot in that December meeting is going to be disappointed. So what has happened also? And back a few weeks ago, we spoke about the dollar before anyone was talking about the dollar is all that matters, especially for financial assets. As you can see here, the dollar's off its peak, but it hasn't broken down. Okay, a lot of people saying, oh, the dollar hasn't broken down. So if we get 50 basis points, this dollar may make another run, and it's going to hit the market. Stock prices cannot go up with a strong dollar. Okay, they're not going to go up. So the dollar's not broken. You have to watch the dollar versus all other assets, including stocks, including gold. And now that I mentioned gold, let's look at something interesting about gold. I talked about gold being support level around 140, 150. It touched the 150 mark. It has bounced off because the dollar was weak. I think gold's going to come back a little bit. I am bullish on gold. But here's another reason that it's interesting. So it's getting tougher and tougher to mine gold, especially with all of the emphasis on sustainability, climate change, et cetera, et cetera. These gold companies are having a lot of problems. They have to look for gold in more expensive places. And unfortunately, like a Bitcoin, for example, is very similar. But gold has been happening for a long period of time. As it gets more tougher to mine gold, the price of gold goes higher. So you have central banks buying gold. You got the dollar most likely weakening over time. Maybe not in the very short term, it might come back, but weakening over time. So all this is very bullish on gold. I would be more comfortably holding gold even over stocks because gold cannot have earnings problems. Okay, so I think gold is definitely something to look for on a pullback. But now that I mentioned earnings, let's talk about earnings. The earnings are the most important thing. So all of this economic data is leading to more earnings declines, especially in the consumer. Here we got Morgan Stanley's earnings model. I don't like pushing broker stuff, but I think Morgan Stanley is fairly reliable. and here's what they're saying. Earnings are going to be lower for longer through the end of 2023. Stocks, we got rising rates, declining earnings. That is not an environment to buy stocks. Sure, you can trade these bear market rallies. If you're a trader, you put in stops, you're doing pretty well. But this is not a time to be allocating lots of money to index funds and just buying the S&P and all that kind of stuff. You got to be really careful because we are still in higher rates and an earnings decline. So now that I mentioned Morgan Stanley, I want to talk a little about Wall Street hypocrisy. I came from Wall Street. I saw what was going on. I mean, it's just it's unbelievable. Let's look at it. Let's look at one of the darlings of finance. This company called SoftBank. These are the guys that had billions of dollars. They financed WeWork. They financed every tech company. Folks, they're losing their shirts. Okay, they are losing their shirts. They finance most of this through bonds. That's why Wall Street loves them. SoftBank did a lot of bonds, especially in Japan and Asia. They owe tons of money every month on interest. All they own in their portfolio is tech stocks, and they're all tumbling. They've lost billions upon billions of dollars. This company is in real trouble. Okay, you looked at FTX on the crypto side. SoftBank is like an FTX here because I don't think there's any fraud going on, but certainly there's a mismatch with assets and liabilities. Big mismatch, and they are in big trouble. But again, this is one of the big Wall Street darlings that is now, basically on the balls of its arse, as they say in the UK. Again, another sign. This Wall Street. Again, I don't have anything against this company, Open Door Technologies. It was a good company. I think the fact that they bought thousands of houses sight unseen was a big mistake. They should have stayed what they were doing in the previous when they first started. But again, this is Wall Street hypocrisy. Okay, Open Door, like all these other funds, including Blackstone, they are the cause of this real estate bubble. They were buying thousands of houses sight unseen. They took all the inventory off the market, created an artificial bubble. Now it's all collapsing. Open Door, when we first looked at it, was 28. It's now like 2. Look at it yourself. Clearly the canary in a coal mine. Look at Credit Suisse. I'm not going to blame, but I mean, this is typical of Wall Street. As of November 4th, they still had high target prices and an outperform on the stock. I mean, this company look, technically, if you mark to market their assets, companies get gone. It's gone. And yet you got an analyst saying outperform. Look, start of the year, Goldman Sachs. Hey, Goldman Sachs, this is a buy. I mean, the signs were there even in February, January. The stock was down 50% from the highs. The rates were, the bubbling of rates was beginning to talk. Rates were starting to go up. There was a lot of talk. I mean, this is not the company I would want to own during this, but yet Wall Street tells you to buy, and they're still telling you to buy this thing. I mean, this is craziness. Okay, absolute craziness. And I don't know. So this is what it's all about. And so I always like to try to close on something positive. I don't have anything positive to say, but I do say in this date, November 16th, 1914, very historic date, the Federal Reserve was newly created. And on this date, they opened their Federal Reserve banks in 12 cities around the country. Now, why is that important? Well, look, the Federal Reserve is what it is. I don't think much of the Federal Reserve, but it is interesting to know that today, in 1914, is when the Federal Reserve branched out all over this country and started to really take over what we know as monetary policy. Anyway, listen, if you're an investor, as always, be careful out there.